This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Alright, however, I said at the beginning, there are two ways a company can raise money. They either raise it from shareholders, boom, or they raise it from borrowings, from debt. And so, let's now look at the cost of debt. Again, on its own, we'll put the two together afterwards. For the moment, just the cost of debt finance. And debt finance, well, either occasionally it's a straight loan from the bank, and if it's a loan from the bank, it's easy. If you're borrowing from the bank at 10%, it's costing 10%. I don't think I need to say any more. Yeah, it's always fixed interest in the exam. However, where the work comes, and what's normally the situation, is that your debt finance is traded debt. The company is issuing debentures, loan stock, bonds. All right? And we're expected to work out the cost. Now here, they're basically exactly the same idea, in that we looked... Oh, I've lost... No, it's here. Before break, we looked at how traded debt was valued. It was the receipts they expected, it was the return they required. Well, again, if we're a quoted company, we will know the value of the debt. We're going to work backwards to work out what the required return is. Okay? It's the same idea. But again, you've got the two types of debt, redeemable, irredeemable. So first of all, irredeemable debt. Can you look at example 7, please? Irredeemable debt, which, remember, is where it's never repayable. Okay? Look at the example. FPLC has in issue 8% irredeemable debentures. 8%, remember, is the interest on nominal. The market value today is 90 per 100 nominal, ex int. It wants to know what is the investor's required return. Well, I really don't think I need to go on here. Surely, if you are buying the debt today on the stock exchange, you'll be paying out 90. You'll be receiving $8 a year. Surely, therefore, if you buy it today on the stock exchange, $8 for every 90 invested, the return you'll be getting to two decimal places, is it 8.89%? Hello? Everybody? 8.89. And of course, why is it relevant to us? I know I said it before and I said I wouldn't repeat, but I'm going to. The existing debt, presumably, when we raise the money, they gave us 100, we give them $8 a year. The existing debt is costing us 8%. But I don't care, because that money's already been invested. What I'm after is what interest will I have to pay on any new money raised? You with me? And if I were to raise money today from debt, surely I'm going to have to offer 8.89% to them. Otherwise, why should anybody lend me money? They can get 8.89 by buying existing debt on the stock exchange. All right? Well, again, arithmetically, obviously, that's a joke. However, although that's the return the investors are demanding, remember, they fix market value. If they wanted a different return, they'd have fixed a different market value. And although, therefore, the company's having to pay them 8.89 on any new money, you're all aware that debt interest for the company is tax allowable. And that although they'll be paying them effectively 8.89, the company will save tax on any interest they pay. And if they're saving tax, it effectively makes it cheaper. Part B says, what is the cost to the company if the tax rate is 30%? The cost to the company, the cost of debt. It'll be very obvious. You can get the answer two ways. Surely, the cost to the company, you are effectively going to be paying them 8 on every 90. But if it's tax allowable, every 8 you pay will save you 30% of 8 tax. Effectively, the net cost will only be 70%. Would you agree? And so, how much is it costing us? You're paying 8 on every 90, but with tax relief at 30%, you are all clear? The net cost is only 70%. And therefore, the net cost to the company, I think, is 6.22%. Does that make sense, everybody? Alternatively, and I'm not playing games here, but alternatively, of course, you could have said, well, the investors are getting 8.89. However, we're saving 30% tax. You could have said, oh, 8.89. 30% tax saving, it'll only cost us 70% or 0.7 of it. And surely you'll get exactly the same answer, I hope. 6.22%. So it doesn't matter. But it's simply that if all they asked you was to the cost of debt, you might as well write it straight down. It seems a bit of a waste of time to write that down and then that. You with me? If they had asked you to work out the return to investors first, then, of course, if you've had to work out the 8.89, it's quicker then. Yeah, they're both the same. All right? Obviously, we are assuming, A, that debt is tax allowable, but you always would make that assumption. You're also assuming, of course, that we have sufficient profits to get the tax relief on. You know, if the company was making no profit, you wouldn't get... You take my point, I hope. You always would assume that. But as a result, the cost of debt is lower than the return you give to the investors because of that tax saving. And of course, I didn't mention that when we did cost of equity. Because cost of equity, dividends, of course, are not tax allowable. And so, if shareholders want 10%, company pays 10%. It's irrelevant, you know, the fact that there might be tax. Clear? Well, that's irredeemable debt. I personally think this is silly. If you want a formula, then the cost of debt is either the interest times 1 minus t over the market value. That's that way I did it, where t is the tax rate. Do I need to write the symbols down? I is the interest, P0 is the market value, t is the tax rate. Or Now here, doesn't really matter here, but it will matter later. The examiner is awfully confusing. The alternative is it's KD times 1 minus T, where KD is the return to investors. I say that KD appears again somewhere else. KD is the return to investors. The investors are getting 8.89. The cost to the company, we get tax relief, multiplied by 1 minus T, here 70%. Okay? So we're nearly there. We all happy with that one? Irredeemable? Easy. And remember what I said before, debt's always irredeemable unless he says different. However, very often he does have redeemable debt. A redeemable debt is the only one that takes time. You've got to admit, even though it's taken me a while, cost of equity is simply sticking figures in a formula. Irredeemable debt, well, whether you learn a formula or whether it seems obvious, I don't care, it's easy. The only one that takes any time, and the reason, therefore, it's quite popular, is redeemable debt. Look at example 8. G has in issue 6% debentures quoted at 85. The debentures are redeemable in 5 years' time at a premium of 10%. Again, I want to know A, the return to investors, KD, and B, because of tax, the cost to the company. All right? Return to investors. Now, again, it is going to be a work backwards from what we did earlier. But this morning, when it was redeemable, what fixed the market value? The market value was the present value of expected receipts, discounted at the rate of return. Do you remember? Let's write that down. Always do it on $100 nominal. Leave a line space, you'll see why in a minute. But on $100 nominal, what receipts is the investor expecting? Now say leave a line or two space, but the investor's expecting, the interest rate is 6% on nominal, so they're expecting interest of $6 per annum. It's redeemable in 5 years, so $6 per annum for 5 years. And in 5 years' time, they'll be expecting the repayment. We're doing $100 nominal, it's being repaid at a premium of 10%. 110. So there are the investors' expected receipts. If I'd have told you the required return, the market value, you would simply have discounted like we did earlier. Here, though, we know the market value. What is the market value? $100 nominal has a market value of 85. And so anybody buying this debenture will pay out 85 and then get those receipts. And we want to work backwards. I want to know what rate of interest makes the present value of those equal to the market value of 85. Do you agree? Or, putting it another way, if the present value of those is 85, the net present value of the whole thing will be 0. True? How can I work out what rate of interest will make the net present value of the whole thing equal to 0? Andre has an excuse, the other three of you don't. I say again, I need to know what rate of interest makes the present value of those equal to 85, or the net present value of the whole thing equal to 0. What rate of interest gives a net present value of 0? How could I work it out? I don't want a number, I want to know how. The rate of interest that gives a net present value of 0. Andre has an excuse. He wasn't here last time. You three were, but maybe your brains weren't. Oh, well, don't turn back now, but if not now... Oh, sorry. We did spend quite a bit of time last time, on one of the chapters, on something called the internal rate of return. KD, which remember is the return to investors, is equal to the internal rate of return of those flows. The internal rate of return, by definition, is the rate of interest that gives the net present value of 0. Last time, we were working it out for projects. What rate of interest gave an NPV of 0? Here, we need it for a different reason. But it's exactly the same arithmetic. We're going to work out the internal rate of return, the rate of interest that gives a net present value of 0. And since we all seem to have forgotten what that was, the internal rate of return, you make 2 guesses and approximate. Let's guess first of all at 10%. Check me, I don't want to waste time here. But 85 now, the present value is 85 now. The annuity, the interest, 5 years at $6 a year. The annuity table, discount for 5 years at 10%. The total factor is 3.791. The repayment, the ordinary discount factor, 5 years at 10%, 0.621. The present value at 10%. I get a net present value of I get 6.06 positive. Now, come on, please. I don't mind the fact you're not all checking me. But I do mind. Are we all clear what I'm doing here? Vita? Discounting? You sure? Well, I've discounted at 10% and I get plus 6. I want to know what rate of interest ends up giving me 0. Is it going to be more than 10 or less than 10? To get 0, will it be more than 10% or less than 10%? More. Higher rate of interest, less worthwhile. And so let's make a second guess. At more than 10%, I'll guess at 15%. So let's redo it at 15%. 85 now is 85. The interest, 5 years at 15. The discount factor is what? The annuity factor for 5 years at 15 is 3.352. The repayment, the ordinary factor for 5 years at 15 is 0.497. And therefore, the present value, 6 times 3.352, is 20.11. The repayment, 110 times 0.497, 54.67. I get minus 10.22. Well, to be quite honest, I really shouldn't need to do what I'm about to do, but since you all seem to have forgotten, as though you've never even heard the word, let me go through it just that one more time slowly. At 10%, we got plus 6. At 15%, we got minus 10. The rate of interest to get 0 must be somewhere between 10 and 15. In the exam, you never make more guesses. We simply approximate between the two. And I say the last time I'm going to write it up slowly. What did we get? At 10%, we got plus 6.06. At 15%, we got minus 10.22. Set it up any way you want. I'll do it the way I always do. We simply say the difference over a change of 5 percentages. The MPV fell from plus 6 to minus 10. It fell by 16.28. To estimate the internal rate of return, take your first guess of 10%. We know it's more than 10. We want an MPV of 0. We need the MPV to fall by 6. We know a fall of 16 is 5 percentages. If 16 is 5 percentages, 6 to get 0 is 6 sixteenths. It's that fraction of 5 percentages. We want a fall of 6 to get to 0. Again, if a fall of 16 is 5, a fall of 6 is that fraction of 5. And therefore, the internal rate of return for an MPV of 0 I get to 2 decimal places 11.86%. Now, I'm sorry. All right, Andre, you haven't seen it. I hope that made sense. It's very rare that there isn't one of those somewhere in the exam, whatever the reason. You three have seen it, I'm sorry, and it wasn't that many weeks ago. You could be asked to do that for a project. Here we're doing it for different reasons, but it's exactly the same, what you might call definition, and exactly the same arithmetic. Okay? Again, I did say before, and I'm not really worried here, in fact, it is only approximate, because we assume it's linear, and in real life it isn't. In the exam, though, he would expect you to leave it, for the moment anyway, to 2 decimal places. Then it's clear, you can see what you're doing. All right? However, that is the return to investors. KD. Now come on, think for a minute. Why is the market value 85? It's because They're getting receipts of that. They're discounting at their required return of 11.86. And of course, if you discount 11.86, you'll get 85. We worked backwards. Okay? However, I'm afraid there is one problem. That is the return to investors. And if you're asked for the return to the investors, that's it, 11.86%. However, what I'm really interested in is the cost to the... Don't worry, only 15 left. No, what we're interested in really is the cost to the company. Why won't the cost to the company be 11.8? Because there'll be tax savings. I said we make that assumption. But I'm afraid we've got a problem. We always assume that we do get the tax saving, but tax saving is on the interest each year. We do not save tax on the repayment. And so I'm afraid there is no quick way here. If we want to know the cost of debt to the company, we're going to do exactly the same thing for the same reasons, but take account of the fact that interest is tax allowable. Again, do it on $100 nominal. Set up your cash flows in the same way. So the market value now is 85. The interest each year, we're paying interest for 5 years. However, although the interest on nominal is, again, am I on the right question, $6? There's tax relief on the interest, so effectively it's only costing the company for the same reasons as before. Sorry, tax is 30% in this question. So it's effectively only $4.20 a year. In 5 years' time there's the repayment. The repayment, though, is not tax allowable. And so, no tax relief. It was a premium of 10%, it's 110. All right? Well, again, the cost, for the same reasons, I won't repeat, is the internal rate of return. But again, there is no quick way. We've got to do 2 guesses and approximate. Can you do it, please? I'll do 10% first, like before. Depending whether it's plus or minus, a second guess, and off we go. Okay? I am right, I think. That I've guessed at 10%. I would usually make my first guess at 10. It's in the middle of the tables. If you discount at 10, you get minus 0.77. Because it's negative, it must be a little bit less than 10. I've made a second guess, therefore. I guessed at 5. I always either do 5 or 15. I guessed at 5 and I got plus 19.42. You then approximate between the two as we did before. Between 5 and 10 is a change of 5%. The MPV plus 19 minus 0.7, it changes by 20. And then you can write it straight down. We knew it was more than 5. A fall of 19 to get to 0. If 20 is 5, 19 is that proportion of 5. You should have got 9.81. Okay? You can practice another one later. But is it making sense? Fine. Now, clearly, that's the one that takes time. Although, quite honestly, even though you seem to have forgotten ever having seen it before, when you've done a few, it actually should get pretty quick, you know? But it's the only one which isn't just sticking figures in a formula, which is why it is very popular. You know, otherwise you can't give that many marks just for putting figures in a formula, clearly. All right? So it's very likely indeed. It is very, very unlikely that you'll be asked to do both. Read carefully. It's very unlikely he'll ask you for the return to investors. Very unlikely. Normally, all we're interested in is the cost to the company, in which case you would go straight to the second one. All right? So read, just in case he sort of throws a bit in, what's the return to investors? But it is very unlikely indeed. It's very unusual for him to ask you to do it twice. All right? But do realise, I hope it's obvious, but because of something I'll mention later, that if it's redeemable, the cost of debt, are you happy with this symbol, is not equal to the return to investors, KD, times 1 minus T. If it's redeemable, I just showed you. Sorry, if it's irredeemable. I showed you a moment ago, if it's irredeemable, if investors want 10, if there's tax 30%, company pays 7. Yeah? If it's redeemable debt, you cannot go from one to the other. I think you're clear what I'm getting at. Now, I say again, it would be very unusual to want both. But if he had done what I've done here, if he said what's the return to investors, and he then said what's the cost of debt, there is no quick way. You would have to do it a second time. Is that clear? Okay. All right, finally, and we have time, that clock's fast. We're 20 minutes before lunch. No, it won't take a moment, just a very quick thing before lunch. And then after lunch, I'll give you a bit of time to practice. That's all, for the moment anyway, in working out cost to equity. Cost to equity, use the formula. I'm not going to repeat. Cost of debt. If it's irredeemable, very quick, interest on market value, less tax relief. If it's redeemable, clearly it takes that bit longer, internal rate of return. But finally, I did say at the beginning, clearly, most companies borrow money from both places, if you understand me. Some of the money obviously has to be from equity, but likely some from debt. And so, he can ask you to work out what we call the average cost of money. Now, for the moment, purely arithmetic. We need to discuss this after, it's terribly important. But purely for arithmetic for the moment, let me show you how we work out the average cost of capital. Can you look at example 9, which is actually a very quick one. Example 9. Can you cross out A? A would be wasting everybody's time. Can you cross out A? Return to investors. He very, very rarely asks return to investors. I don't care. J plc is financed as follows. Equity. Some of our money's from shares, 5 million. We'll read the figures in a moment. Some of our money's from debt. Okay? Well, first of all, we work out separately what's the cost of equity and what's the cost of debt. So we've done everything we need. Let's work out individually what's the cost of each. Okay? Vita? Well, equity, of course, always the formula. So a joke mark in the exam, write it down. D naught, 1 plus G over P naught plus G. Well, I've kept this very short deliberately. What's D naught, please?
32.
It's 32 cents. What's G? Zero. It's a constant dividend of 32. If it's a constant dividend, the easiest you could ever get, G is 0, irrelevant. Divide by the ex-div market value. P naught. What's the ex-div market value? Yeah, a tiny trick here. Usually market values are ex-div, but I told you the market value here is 250 cum-div. Well, remember the cum-div value is always higher than ex-div by the amount of the dividend. You agree? And so the ex-div market value take off the dividend. I'm working in cents, so it's 218. Everybody? And so the cost of equity, 32 over 218. Please check me. I get 14.68%. All right? Now, of course, I could have made that a bit harder by having growth in dividends. I'll give you some growth after lunch. But whether it's easy or hard, we've done everything we need there. You work out cost of equity using the formula. All right, so equity finance is costing us 14, but some money's from debt. So let's work out separately the cost of debt. And again, I've deliberately kept this as short as I can. This debt, there's no mention of any repayment date, and therefore we'll assume it's irredeemable. Agreed? And if it's irredeemable debt, the cost of debt is simply the interest times 1 minus t over market value. Again, it's quick. The interest, they're paying 8% on nominal. The tax rate is 30%, so 1 minus t is 0.7. The market value of 100 nominal is 92. And so the cost of debt, $6.09. Everybody? So nothing new. Again, that's likely to take longer because it's likely to be redeemable. We've done what we need, but here, very quick indeed. Constant dividend, irredeemable debt. Everybody? Well, fine. Some of the money, therefore, they're borrowing at 6. Some they're borrowing at 14. as an arithmetic exercise, you can be asked to work out the weighted average cost of capital. It means exactly what it says. If some of the money's at 6, some of the money's at 14, the average, of course, is somewhere in between. All right? We take a weighted average. But watch me. It's so easy it's untrue. Equity debt. We know what the cost is. We just worked out. Equity, 14.68, debt 6.09. You all know, I hope, what I mean by a weighted average. You know, if most of the money was equity, it's nearer 14. If most of the money was debt, it's nearer 6. Well, importantly, you always weight by the total market values. How much of this company's money is being borrowed from debt? The total market value of debt. There's 4 million debentures, but that's nominal. The market value is 92 per 100. And so the market value of the debt in total, 3.68 million. What's the total equity borrowing? Well, although I didn't write in, you can write in if you want. Always we weight by ex-div, ex-int market values. So equity, how much in total? There's 5 million shares. We'd already worked out the ex-div market value per share was $2. Was it $2.18? And so the total market value of the equity borrowing, 5 million at $2.18, is 10.9 million. Well, we're going to take a weighted average. The total value of the whole company is 14.58 million. To get a weighted average, well, equity, 10.9 out of 14.58 times 14.68%. Debt is 3.68 out of a total of 14.58, 6.09%. Multiply and add, and we've got our weighted average. Now I'll put the numbers in, but again, are we clear what I'm doing there? Alright, let's not waste time, as fast as we can. I'm not going to waste your time. I think I'm right. 12.51. That figure is desperately important. We'll discuss why after lunch. But whether cost equity, cost of debt, whether they're very easy as here or whether it takes longer because of growth, because of redeemable, we work them out individually. It's then a weighted average, weighting by total market values. Okay?